welcome to this week's edition of Wealthy and Wise. Well, some of the ASX's biggest blue chips have been smashed over the past year, but are investors witnessing genuine business deterioration or simply valuation gravity pulling prices back to earth? So this week on Wealthy and Wise, we unpack PE mean reversion, market expectations, and why some of 2026's so-called wealth destroyers may actually be quality companies hiding in plain sight. Plus, we answer one of your questions. First, as usual, let's add some value. Well, markets often look chaotic in the short term, but over time, we're told valuations tend to move back toward historical norms. So in this segment, let's break down PE mean reversion, why sentiment can overshoot in both directions, and what happens when great businesses become perhaps priced for perfection. Andrew Coleman from Teaminvest joins me now. Andrew, welcome. Look, we have touched upon PE mean reversion in the past, but we've sort of glossed over it. So I would like you to tell us, what exactly do you mean by PE mean reversion?
Great question. So it's simply the idea that over time, a dollar of earnings should be worth the same no matter its source. So whether you earn a dollar from a company in technology or a dollar from a company in mining or a dollar from a company in manufacturing, as an investor, you don't care. It's still a dollar. And so all of that short-term sentiment, that idea of euphoria about one market or industry or company, or fear about one market or industry, in the long run will dissipate away. And what will be left is simply the dollars that you earn, as a result of which you know that the sentiment will go up and down, but you can value a business based simply on the dollars that are left. And that up and down of sentiment is what we refer to as PE, mean reversion. And the PE ratio, of course, is the price investors are prepared to pay for every dollar of earnings. So it's a really simple proxy for how investors feel.
Yeah. So why is it that investors sometimes are willing to pay more for quality companies during, these bouts of market optimism? Because the point of this is that it's not just, forgive me, the drone shields and those that get into those really hot thematics, but sometimes, investors get over enthusiastic about even good companies.
Yeah, I think at the end of the day, we're all human, right? And we can convince ourselves, we did on one of the previous episodes, we talked about valuation and forward valuations using things like discounted cash flows and multiples approaches. And so as a result, in the market every day, people are trying to work out what the business will be worth in the future. And as a result, they have all these different assumptions that are going into it. And when we're feeling happy, those assumptions tend to be quite bullish. This company will keep growing at X% forever. And when we're feeling sad or upset or angry, we tend to discount the same assumptions. So from that point of view, there's definitely an element of euphoria that enters into the expectations of future growth, as an example, or the expectations of future discount rate. What will inflation be? How risky is this asset? And that's partly, I think, what drives it. At least that's a nice scientific answer. If you wanted the cynical answer, I would say sales, sales, and more sales. The companies that are out there doing a better job of spruiking themselves get people excited and get a higher PE, and the companies that are out there maybe kicking goals but not telling anyone about it tend to get a lower PE.
All right. So does it mean that reversion sort of accounts more for market moves than people realize at times?
Absolutely. So it's a really interesting piece of analysis. But if you have a look at the ASX 50, since February last year, 25 of the ASX 50 have fallen, which is why we're all talking about this feel right now of the ASX 50 being a wealth destroyer. 20 of them have fallen more than 10%, which is pretty material. 12 have fallen more than 25%, and 4 have fallen more than half, which is a pretty dramatic shift from where we were on TV about a year ago, you and I talking about it, where the feeling was large caps can only go up. Why would you ever want to invest outside the biggest of the blue chips? Because with passive money and index flows, they'll only keep rising. And of course, that's not what's happened. And so we've got a graph up here at the moment. This is just simply a scatter plot of the distribution of returns from the ASX 50. So each of those blue dots is one of the companies in the ASX 50. North and south of that line is simply positive returns and negative returns. And as you can see, some of them are pretty big negative and some are pretty high positive. And the x-axis, because I needed to graph them on something, is the PE they were trading on back in February 2025. Now, it's always hard in a zoomed out chart to see a lot of pattern, But there's two things that stand out pretty obviously to me, and I think to most people looking at it. The first is half of them are above the line and half of them are below the line. We just said that. Half the companies have fallen, half of them have risen. But that also, if you have a look, you can start to see the beginnings of a trend, which is much, much better viewed when we zoom in. So, I always tend to think that the best thing you should do as a long-term investor or a value investor is go back to first principles and say, without knowing anything about what's happened to any of those companies in the ASX 50, what would I have expected returns to be? In other words, take out any scandal or impropriety or incompetence or changes in Iran and the war or oil or anything like that, and just say, if I'd known nothing else, in February 2025 last year, what would the first principles of economics have told me? And the answer, of course, is that first principles would have said the companies on very high PEs are more likely to have a bad return as sentiment shifts. The companies on low PEs are likely to have a higher return as sentiment shifts. And those around the middle PEs, sort of around that 20 times long-term market average, would have had close to zero return. Now, of course, there's a whole bunch of factors that could have affected the companies individually. But what I've done to sort of demonstrate it for everyone here is those three lines are the expected returns simply from PE mean reversion. The middle line is if everything worked perfectly, the world was perfectly, exact to finance theory. So what would have happened exactly if it was just PE mean reversion? And the line above and the line below are the confidence intervals. The pretty much what you would expect to happen without knowing anything else. So, the sort of accounting for just general noise. And what you actually find when you run those three lines across the ASX 50 is that 45 of the 50 movements of ASX 50 companies in the last year can be explained entirely on the concept of mean reversion alone, without knowing anything about the industry they're in, without knowing what their tickers are, without knowing anything about scandals or management incompetence or war in Iran or anything else. You could have predicted that result just off the starting PE, which tells you it's a pretty powerful theory.
Right. So when a stock falls sharply, though, how do you distinguish between that valuation reset, that PE mean reversion, and a genuinely broken business?
It's a great question. And it's a hard one to do as an investor, right? Because I think the reality is if you start without looking at the company at all, you can have an expectation of what you expect to happen. That's the answer that PE mean reversion, for example, will tell you. The challenge then is when you see it in practice to not make the mistake of what we call in research post hoc rationalization, which is really just a fancy way of saying fitting what you're seeing to the data. So a great example, let's take Cochlear. Cochlear has had a big fall. We're going to talk about it later in more detail. Cochlear's fall can be explained from one of two reasons. Its fall can be explained from PE mean reversion or because of something specific to Cochlear. The challenge becomes as an investor trying to work out which of those is the bigger element at play and putting your ego aside and effectively going back to that first principle and saying, what would have happened if I knew nothing about the company? That's the challenge. It's hard to do. And it doesn't mean it's always going to be right. A company can mean revert up or down at the same time as something changing in the business. They don't have to be completely separate. But push comes to shove, most of the time we try and find a really strong reason when realistically, post hoc rationalization is wrong and your pre-assumption would have been right.
Okay. So just finally, and I hope I'm not sort of asking the same question in different ways, but what are the key things that you would check to decide whether mean reversion is likely to play out at some point? Or is it just a pure fact that when the PE ratio gets well ahead of what the business is genuinely valued in your view, that there will always be a mean reversion?
Well, there's always a mean reversion. That's a truism. The question is the time frame of that mean reversion. So, in the end, all companies going through mean reversion. If they start low, they end up high. If they start high, they end up low, and then they go through that cycle. The question is the time frame. And I think the challenge that you're highlighting there is what is the catalyst for when that mean reversion is likely to occur? So mean reversion will happen. It might happen in a month, it might happen in 6 months, it might happen in 2 years, it might be 10 years, right? Eventually it has to happen. That's a truism of economic theory. The question is the time frame, and the time frame is often driven by news, announcements from companies, and just changes in global sentiment, exogenous factors. So to your point, if you take healthcare as a sector, healthcare rode high on the ASX for about 8-9 years, well above where mean reversion said it would be. Then there was a catalyst. what was the catalyst for healthcare dropping? I can't necessarily put my finger on it, but it happened about 9 months ago, didn't it? Where all healthcare started to drop. Didn't matter what healthcare company it was. Same thing with tech, and then vice versa with mining. You know, mining was dead. Coal mining, a great example. No one would touch a coal miner. Suddenly they're all trading on big P's again, right? So the challenge is to separate the fact that reversion will occur from the catalyst of what is going to trigger it this time. Now, if you're a long-term investor, that's an irrelevance, because you don't care about when the catalyst occurs. You're already going to hold for 5, 10, 15 years. It's going to be in your cycle. If you're a trader, it's very critical to work out what the catalyst is, because expecting to get a return tomorrow as a day trader, but knowing PE mean reversion might take up to a decade, is probably not very useful.
Yeah. All right. So we are talking around companies. That's my cue. Let's take a bit of a look at these companies when we go head to head.
Wherever you are in Australia or New Zealand, there are investors like you who are done going it alone. The best investors we know aren't just disciplined, they're connected. Teaminvest is an exclusive membership for long-term, self-directed investors who approach investing like business owners and compound their knowledge alongside 700 plus peers. Masterclasses held across 9 cities. Register your interest by clicking on the link in the caption.
So from healthcare leaders to industrial champions, some of Australia's highest quality companies have suffered some major share price falls over the past year and even the past, week or so. So are these warning signs investors should fear, or potential opportunities created by market overreaction? So 6 ASX heavyweights head to head through the lens of valuation, earnings, and mean reversion. Andrew Coleman, Teaminvest. Let's start with the big picture. How much of these declines in the companies that we will be mentioning do you think can be explained by PE mean reversion? So we've got CSL, we've got Cochlear, we've got ResMed, we've got Wesfarmers, we've got WiseTech, and I'm forgetting one, but we'll get there. Cochlear.
Cochlear.
Yeah.
At the risk of doing myself out of a gig regularly on the show, pretty much all of it.
Okay.
And I say that because it's a very natural human tendency to want to talk about, in particularly a few of those companies, all of the scandal and noise and potential incompetence and disruption and new technology and all of the stuff we've had over the last year. I mean, you've picked a really good set of 6 companies, because you've really got everything that's happened, from GLP-1 drugs to AI to changes in global healthcare spend to oil prices to global supply disruptions to scandals around illegal activity. I mean, this is a great set of great journalistic stories, right? But the interesting thing is that for all of those as individual catalysts for these companies, and they have been individual catalysts for these companies, if you had simply asked a year ago, what is my expected return if mean reversion occurs, which is this chart that we've put up here, you're going to see a pretty scary thing, which is that with the exception of a couple of over and under corrections, which are not particularly big, but they're there, they track pretty much in line, at least directionally, with what you would have expected. So, just to call a few out here, ResMed, you could have said you would have expected a negative 31%, in other words, roughly a third drop in the share price, simply from mean reversion. And what have we had? 25% drop. Cochlear, a 55% drop. What have we had? 64. WiseTech, an 85% drop, even knowing nothing about Richard White and what's been happening there. And what have you had? A 72% drop. So from that point of view, I think we could spend probably a whole episode on any one of those companies talking about how are they performing, what are they doing, what are the scandals or the opportunities in each. But probably most of that would be hot air, because in reality, you could have predicted that return and did probably predict that return a year in advance for most of them, just simply on saying those PEs are way too high. And eventually they're going to have to come back down to earth.
Okay, so you can see the question that's at the bottom of the screen. So what you're saying is, even when it comes to Cochlear, CSL, ResMed, one of the key questions that I know that you ask as a value investor, what are the moats? So you don't think that anything has happened to damage these moats?
I don't think in any of those companies that you've mentioned, has been anything to damage their moats. I think it's a good point that you're raising, which is sort of the second order part, right? So the first order part is we could have predicted this with mean reversion. Now the question is, going forward though, do you expect mean reversion in the other direction? In other words, the share price for some of those to rise now, or has something broken in the business? In other words, is mean reversion the cause or the outcome? So is it just because of mean reversion they fell, or is it they messed something up so badly, everyone's woken up, they've mean reverted, and they're now going to stay down at this low level for the next decade? And that's really where the question of moats and risks come in and management. Because at the end of the day, if a business is truly broken, its earnings are going to decline from here on out, it's shrinking in size, then a reverting PE will help, but it's not going to make up for the shrinking business. If a business halves in size, physical size, then you have to more than double the PE just to get back to where you started. So the question you need to ask as an investor on any company that's fallen is really three things. Firstly, number one, is there any reason to believe that this business is broken? It's materially in trouble. And I don't mean, a journalistic article or a great comment in the AFR or, Joe Aston writing something funny in Rampart. I mean, broken, no revenue or significant reductions in revenue and profit going forward. The second question you need to ask, has anything happened to damage, to your point, the moats of the business? And you'll see that in the margins that they make on their product, right? The third one then, has any major risk triggered? Has something changed in relation to the way the business is structured or operates, or the world in which it operates, that says maybe its good or service is no longer needed, or maybe the management team can no longer be trusted to run the business well, or perhaps the board are lining their own pockets rather than looking after shareholders? And of course, if you do find something in one of those three sections, then PE mean reversion may help you make a short-term return, but it's never going to overcome the bad mistakes. On the other hand, if there's nothing wrong with the business as a whole, then buying the stuff that's beaten down and waiting for the PE mean reversion to come in your favor tends to be a very good strategy. And you can see just how powerful it can be. I think we can bring up a chart, which is if you take today's PE for all those companies, Monday's close PE.
PME is the one I forgot.
PME, yes, there you go. And you just say, if it mean reverts towards 20 times, which is the long-term market average, how will these businesses go as investments from here? And the interesting thing that pulls out, of course, is the ones on low PE, so CSL, ResMed, and Cochlear, are likely to be pretty good investments. The three that are still on quite high PEs, despite the fall, may not look so pleasant, even if the business continues to be the way it is, just mean reversion. And then you say, well, what if, okay, $1 of earnings in the future is not going to be as good? There is something slightly wrong with the business, not completely broken, but it's not the business it used to be. And so it's going to trade at a PE of 15 times in the future. And you can run that analysis and you can say, no, everything's going to go back to where the market was a year ago, where the market average PE was 25 times and people were feeling bullish, and you can see what they look like. Now, I don't know about you, but a very obvious thing stands out to me, and I presume the viewers at home, which is there's one company with all three greens, two companies with greens if things get back to sort of normal, and three companies where even if things get back to normal, as an investor, you are likely to suffer short-term future losses. So the question you have to ask is where to from there, and what would you want to do with it? Now, we in Teaminvest, and we are doing this right now, we're spending our time looking at those three companies that have green on them to ask exactly those questions. Is it PE mean reversion, and things are going to look really good next year or the year after? Or is the business fundamentally broken? And we can talk about those individually. And then for the three that are on red, we're saying, look, even if we think they're great businesses, why would you be adding to them in your portfolio right now, knowing that almost anything tells you if you buy it now, you've overpaid?
Yeah. And so in short form, PME, Wesfarmers, and WiseTech are value traps where you can be lured into thinking that they are looking good value right now. But when you crunch the numbers, even when you're taking into consideration those different PE scenarios, they still look expensive.
Yeah, well, you take PME, I think it's a wonderful company. We've spoken about it before, but it was on a PE of 290. So the fact that it's fallen 60, 70% since then still doesn't put it on a cheap PE. It still means it's on a PE of, if you include the 40x gain, 55, and you exclude the 40x gain, over 100. So from that point of view, it's still got a lot further to fall if mean reversion kicks in. And the same for Wesfarmers and WiseTech.
And so do you have a list going at Teaminvest, companies that you are keeping your eye on as potentials for when that mean reversion does kick in for whatever reason?
Yeah, we do, absolutely. And we're probably across the membership and certainly in our funds adding to most of those right now. some to more degrees of comfort than others. If like a company's trading on a PE of 19 times, it may look like there's some mean reversion in it, but it's not really that exciting unless the company itself is growing fast. But some of the others we absolutely are investing in heavily. And I think that's the really interesting part. If you're a long-term value investor and you're doing your work in advance, so, you're filtering the market to remove the dogs, as we've spoken about, you're looking at stability, you're really getting under the hood and understanding these companies pretty well. When the market corrects like it has just corrected, that's your opportunity to really, really do well for the future. Now, you may not be right in the short run. I mean, things can fall further. They always can. But you know that over the long run, as long as the business isn't broken, eventually at some point in the future, sentiment will turn. It's usually about every 18 months. Sometimes it's longer. And at that point, you're going to look like a genius because somehow you're going to end up with a return of, 50, 100, 200% that looks like it came out of thin air, even though it was just following some pretty basic principles.
Okay, so I am going to preempt some of the emails that we get about this one because CSL is a very sore point for a lot of viewers, the bluest of blue chips. And people have told me that it's literally a basket case because their business units are shrinking. There is further competition coming into some of their Why am I saying something funny?
No, I'm giggling because I hear it all the time as well. And I laugh because there's so much that has been said about CSL that is factually incorrect, but it feeds into the narrative because we're talking about sentiment. We just mentioned before, when we're euphoric, everything's going right, even if the data says it isn't. And when we're upset or sad, everything's going badly, even when the data says it isn't. So a great example I just want to pick up on. I mean, by the way, I don't think what CSL's gone through recently is a great, tick on management and board, right? I'm not defending it. But this idea that CSL is broken and shrinking is just not borne out in the numbers. So CSL just did a big downgrade. Market fell. All of that's factually correct, right? But if you listen to how people talk about that downgrade versus actually looking at what the downgrade was, you'd have two completely different orders of magnitude. So I was in a meeting, a public meeting the other day, and people were talking about how CSL is broken as a business and it's shrinking and it was collapsing. And so I asked the question, okay, well, that's great. So you're all CSL shareholders, which a bunch of them were, and you're upset. How much has CSL shrunk? And I got answers ranging from 15% to 50%, which aligns with the share price. So I said, that's great, but what about their revenue and profit, like the actual business, not the sentiment? And I couldn't get an answer from the crowd. Now, the really interesting thing is, you can check all this at home. CSL's announced their new guidance for this year, which was a material downgrade compared to what the analysts wanted. It's $3.1 billion US. That's the number that they've announced. What did they do last year?
3.12?
3.136 billion. Now, 3.136 billion to 3.1, that's the same decimal point.
That it's not growing. So it's because it was being priced as a growth company.
Correct. The PE was high.
Yeah.
The PE for CSL got up into the 50s, which is nuts, but it doesn't matter. But it got up into the 50s on the premise that CSL could grow at 15% forever. Now, anyone with a bit of mathematical training knows that's not possible. A, because you can't compound that number that fast. It just becomes bigger than the world. And B, because as the company gets bigger and bigger, more risk is going to pile up that says not every year is going to be as good as the year before, particularly in something like healthcare where there are lots of things outside your control. So from that point of view, I get it. This has been a shock to people because they've been saying CSL can grow quickly forever, but the business isn't broken. The business is just not growing as fast as it was.
Okay, so we know that you're a long-term CSL shareholder. Have you been adding to your CSL position? And are you?
And I could be very wrong on that because it could turn out, by the way, that the share price drops further or that the business never recovers. But on a PE of sub 11 for a company that does 24 billion Australian in sales and 3.1 billion US in profit, mean reversion says we'll probably double our money from here.
Yeah, okay. And so you're talking in what time frame? Or because I know that you're long-term investors as Buffett value investors, but when you are taking that additional position, because I'm pushing this point because it's relevant for a lot of viewers, you are doing so with what time frame in mind?
I think you've got to think 5 to 10 years, right? And I don't mean that it will only double in 5 to 10 years, but I think if you are investing in businesses as opposed to trading, picking sentiment, you have to give them long enough to A, get their house in order or grow, as they said, and B, for everyone else to wake up to that's occurring. Now, in the case of CSL, 6 months ago, I would have said a much shorter time frame because I think people were still willing to give the benefit of the doubt But the sentiment has shifted so far that CSL is broken, that it's going to take one or two good results. And I don't mean great results. I just mean that the business isn't broken for the market to go, oh, actually, everything's fine, and return. Now, if you're someone like me who has a 5 or 10 year horizon and you say, I expect over that time, CSL will grow not at 15%, but at 5 or 10%, and it's going to double its PE at least from 10, then that's a wonderful investment in that horizon. But if you're a 6-month holder or you're taking out margin loans, I agree it's too risky. But then I would say taking out margin loans or being a short-term investor is risky anyway.
And I think the other cohort, those that bought in at 250, 275, the key lesson would be that price still matters, even if it's a quality business.
CSL reached a peak of, what was it, $342.75 on a PE of 50.
So you never would have been buying then, even if you love the company.
I think convincing yourself to pay 50 times earnings when everything in economic theory tells you it will mean revert at some point seems like a very risky exercise. It's like going on the roller coaster without the harness.
So for long-term investors, value investors, the key lesson is that price and quality are not the same thing.
Yeah, so I think an even better example, because the interesting thing with CSL, of course, is it's so topical and it's so scary at the moment. But a really good example where there's not the same level of emotion is ResMed.
Okay.
So if you ever look at ResMed has continued to grow at roughly the same rate for the last decade. Unlike CSL, there's been no scandal or slowdown. And yet, when healthcare was popular in 2020, 2021, with everything going on in the world with COVID, it got up to a PE of 77. It's now on a PE of 17.5. The company's growth rate hasn't changed. So at least with CSL, you could make an argument the company's growth rate has changed. Maybe something has gone on in the company. In the case of ResMed, you look at the charts, you look at the data, there's been zero change whatsoever. And yet the sentiment has effectively dropped 80%. So that may be a better example for viewers where there's probably less emotion caught up in the bluest of blue chips falling and all the other noise around it.
All right. Look, I think we went head to head, you and I at least. Let's get to our viewer question because, of course, you asked. Well, let's get to a viewer question, and you too can ask a question of the team at wealthy@ausbiz.com.au. Now, our question this week comes from Jim, who caught last week's episode on defense, and he thinks it was fantastic. Thank you. And he has written in light of that, saying, what do you make of newly listed KTech, ASX, KTK? So, Jim, what I've done, just as a little special favor, we've brought back Peter Hasrouni from Teaminvest, who joined us last week as the defense expert, and he's alongside Andrew Coleman, of course. So, Peter, welcome back to the program. I hope I'm not putting you in the hot seat too much because it is a newly listed company, but it's called KTech. And I guess people are really interested in that whole defense thematic because this one is involved with drones. So tell us about it.
It said the other D word, Dan and Dean, were jet drones. So KTech essentially manufactures, if you take a step back and think, a drone really has three key parts. It's the shell, the hull, the wings, the landing gear, the comms and operating system that takes combat orders and or operates it within a system or on its own, and then kind of the sharps or the pointy bits that explode. So KTech really has the engineering and the process tech around the subframes, the hulls, the wings, the landing gear, and the electromagnetic assemblies that attach inside. So if you think it's a shell that has various component parts, and within that shell sits a combat and operating system, and separately the weapons that are attached to the shell. So they engineer, and then they get toll manufactured the individual components, which they call the cordless factory model.
And so I don't want to get too into the nuts and bolts of it, but is this a concept, a company, a business that in your view would have a moat? Those things that we really look for in businesses to make sure that they stand out from the rest and that would actually drive some business from, what is very much a global market to the company?
It's early days yet. I think insofar as if the cordless factory model, they're able to exercise enough manufacturing control as you might imagine, while relatively cheap, tolerances in this kind of technology are quite small. So if someone else is making it for you, even though to your design, you'd have to be very confident that the quality, the tolerances, and the delivery is there. It's not like you can walk down to your own factory floor and have some strongly worded conversations if things go awry. Someone in another part of the world or outside of your direct control is manufacturing your designs within their facilities. So from a remote perspective, it is like cost to ramp up because all you have to do is supply tooling and designs. From another perspective, it really is outside your direct control because it's someone else's factory.
Got it, Peter. All right. So now let's ask you, Andrew, what do you make of this business? It performed well on debut.
Yeah, doubled on the day of listing. I think the challenge, if you're looking at something like this from a value investor or long-term investor's point of view, is trying to get any handle on what is the size of this business and what are the likely returns, particularly when the auditor in the IPO points out that the business is effectively insolvent and requires constant capital raising just to stay afloat. Now, that's not a negative. We have plenty of startups and explorers that list on the ASX. This is not the first one. We have mining explorers that do it all the time, biotechs that do it all the time. But the challenge is to work out what's that business worth. So, if you look at the numbers, K-Tech has a combined historical revenue in all their years of operation of around about $6 million US, for which they have never made a profit. So when you're trying to get a valuation on that, when we talk about our assumptions in a DCF or anything, what are your inputs? How fast is this going to grow? What is their cost control going to look like? Are they going to be able to continue to operate in this kind of model at scale, or they're going to end up being much more capital intensive with having their own factories? And so I would say from a Teaminvest point of view, we'd be putting it in the too hard basket right away because there's just far too much variation in all of that. And then I think if you looked at it from a valuation point of view, you'd say a market cap of about 60 million, which is what it's on now, for a business that's never made a profit and has made combined historical revenue of, even with a good exchange rate, less than $10 million, does seem a little on the rich side. But, if they can get it going, maybe it will grow into its valuation. But I would leave that for other people to take as a risk.
Got it. Well, there's your answer, Jim, because you asked. Peter, thanks for dropping in. Nice to have you. We hope to have you back on the program again. And Andrew Coleman, Teaminvest, thank you for joining us. Really appreciate your time. As always, interesting talking about mean reversion. All right, that is the program for this week. Thanks for joining us. We'll see you next week.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.